In today's video, I'll be discussing the huge Roth conversion mistake that could sink your retirement. Hey folks, I'm David McKnight, best-selling author of The Power of Zero. In today's video, I was interviewed by elite Power of Zero advisor and certified financial planner Mark Bialik from Attleboro Wealth Management, where we discussed the huge Roth conversion mistake that could sink your retirement. We also discussed updates to Roth legislation with Secure Act 2.0, how long tax rates will stay historically low, what happens in 2032 when the Social Security Trust Fund runs out, and how to incorporate the life insurance retirement plan into a comprehensive balanced approach to tax-free retirement.
So I'm probably more conservative in that approach, but it's still, if you can maintain $250,000 that you never have to pay tax on, first of all, it would be a terrible shame to convert that or pass it on to somebody, in a tax inefficient manner. But it's just a big mistake that a lot of people make who aren't tuned into it. Make sense?
Right. So what you touched on is this idea of over-converting. So, yes. We talk about how, and just to make this math really easy, let's say you got $1 million in your IRA and you convert every last dollar of it to your Roth IRA. So you've got zero now in your IRA. You've got $1 million in your Roth IRA, assuming you paid the tax on it from some other source. Well, okay, so now you come to retirement and you're taking all of your money out of your Roth IRA. Yet you have this standard deduction, this $27,700 if you retire today, but it gets indexed for inflation every year. So you got the standard deduction that is now sitting idle. Okay, you don't have any income that you can use to offset, that can be offset by that standard deduction. So what you now have found is that you're in a position where you wish you had some money in your IRA that you could then draw from in a tax-free way by utilizing your standard deduction. So what you'll find is that you really should have, like you said, Mark, between $250,000 and $350,000, because what you'll find is that amount of money will create an RMD when you're 73 that's equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. So instead of converting your IRA from $1 million down to zero, convert it from $1 million down to $350 or $250. You save some taxes along the way because you're not converting the entire thing. And then when you retire, you can then draw the RMD off of that and have that be tax-free because it's offset by your standard deduction.
So let me put my compliance regulation hat on for a second and say it's different for everybody. And it depends on your situation, because if you have other income, rental income, pensions, or something like that, then this strategy won't work. But I got to tell you, if this strategy doesn't work for you, you darn well better move the rest of your funds into the tax-free, tax-advantage bucket, because you've got to protect everything else that you have. So I hope nobody out there wrote down 250, 350. Dave and Mark said I can keep $350,000 in my IRA. That's different for everybody, and it has to be assessed and reviewed. And you should review your plan every single year, like you all hear me say all the time. All right. So I'm going to ask you, what should retirees be doing now?
Well, I think they should be, at the very least, asking themselves the question. One of the most important questions I think people are going to ask themselves, where do I think tax rates are headed? And if the answer to that is the tax rate at which that I'll pay when I distribute money from my IRAs or 401ks somewhere down the road, if you think that tax rate down the road is going to be higher than the tax rate today, then you should probably execute a Roth conversion. So I would think about that. And once again, we do have 3 years until it reverts back to what it was in 2017. But between me, you, and the wall, Mark, we think that's going to be extended, but it's not going to be extended forever. We can't extend it forever. So I'm thinking, you got 8 years or so, maybe 9 years within which to take advantage of these historically low tax rates. So I would think about potentially, and obviously this is different for everybody, but for a lot of the people we meet with, converting to the top of the 24% tax bracket. 24% tax bracket, I talk about in chapter 6 of my updated and revised version of The Power of Zero. I talk about why 24% is my very favorite tax bracket. Because, you know, for 2% more than the 22% tax bracket, you can convert an extra, I think today it's 170,000 or so. You can convert an extra $170,000 to the tax-free bucket. It only costs you 2% more on the margin. So in other words, if you feel good about hitting the top of the 22% tax bracket, you should feel great about hitting the top of the 24%. And by the way, if tax rates do revert back to pre-Trump levels in 2026, the 22 becomes a 25 and the 24 becomes a 28. In other words, the future version of the 22 the future version of the 25 is worse than the present version of the 24.
Yes.
So really, these are great low tax rates. So we're all on the clock, frankly. And so if I were getting ready for retirement, I would be thinking hard about whether I want to hit the top of that 24% tax bracket. If you're in the 12% tax bracket, it's a bit of an ask to say bump up into the 22 or the 24. But if you're already planning on being in the 22, don't let a year go by where you're not going to convert to the top of the 22. And by the way, 24 is only 2% worse. So why not convert to the top of that as well?
Yeah, and that was a good point you just made, because you don't have to be in the 22, 24. You know, good accountants will tell people to take distributions or do something if they have the opportunity to do it in 10, 12, you know, so you should act. You know, we talk about the railroad tracks. We always talk about at the end of our class, take the momentum that you get from the class and do something. Folks, I've got a note here. Don't wait with an exclamation point. So hear me say, don't wait with an exclamation point, because in all the years that I've been doing this now, whether it's just traditional financial planning or now tax efficient financial planning, this specialization, I've never, ever had a person say, geez, I wish I would have waited 5 more years to do this. You know, everybody always said, I wish I would have heard this 10 years ago. I wish I would have heard this 5 years ago. So don't wait, and tell your kids about it. You know, tell your loved ones about it, because one of the best gifts that you can give someone you care about is this information and the ability to act on it. Because think about if you would have known, you know, if you're 65 today listening to this broadcast, and if you would have known about this 20 years ago and had a chance to really unlearn what you've learned, because that's unfortunately what people have to do. We were taught, we are as financial professionals, and many are still taught of this, you know, this tax deferred paradigm that we know now is wrong. We were taught this for 40 plus years, and you've heard it for 40 plus years in your working years. So you have to unlearn it, but don't wait. Just, you know, do your planning, find somebody to help you. You know, if you want to have a discussion with me about what your situation is, you can reach us at admin@attleborowealth.com. The contact page is going to load at the end of this webinar, but you've got to do something, get off those railroad tracks and get away from the train. We can't save everybody, but we want to save you and your loved ones for you folks that are listening tonight. So Dave, let's check in with a couple of questions. You okay with that?
Sure.
Okay. Let me put my readers on. Andrew's busy tonight. Andrew asks, what do you think will be the impact on Social Security and Medicare based on that potential prediction? So this has been sitting for a while. So he's talking about, I believe, and Andrew, you can clarify. I think he's talking about the zeroing, the trust fund going to zero for Social Security and Medicare.
Yeah, so the current prediction is, and just to be clear on what the trust fund is, the trust fund is all of the money that got stored up over the years that, you know, basically was saved for a rainy day. In other words, we've been able to pay these Social Security payments out through incoming revenue, but what's going to happen is the incoming revenue will get to the point where it's not enough. We may have already passed. I think we're already eating into the trust fund. And so the incoming revenue is not enough to pay the outgoing expenses. So we have to dig into that rainy day fund. Well, in 2032, that rainy day fund runs out, that trust fund, and now we've got to pay all Social Security payments based on those FICA payments that are coming in. You know, they're deducted from our paychecks, basically, right? And so what they're predicting is that there's going to be a 23% across the board cut for Social Security. Okay. Now, if the government doesn't want to do that, they're going to have to find some revenue to shore up that trust fund, and that's going to come from higher taxes.
Yeah. Yeah. So I think you said 80% for Medicare and 70% for Social Security, and nobody's going to accept that. Nobody's going to accept that. All right. So Roseanne has a very specific question that I had to read twice. So let me see. I'm gonna ask you to send this to me in an email, but I'll read it for everybody because there's a couple of things that are important in here. As a 72-year-old now filing as a single, can I offset a Roth conversion by using QCD, qualified charitable distribution, for my RMDs? So let me take that one first. You cannot do you have to first do an RMD before you do a Roth conversion. So that's very clear in the tax law. So the QCD has to go directly to the charity. You can't receive that, and so it doesn't even hit your tax return. So I don't see how that would offset a Roth conversion. Then she said, then do a Roth conversion and an amount equivalent to the standard deduction for a single. Now, she said, this year I'm filing a single after years of filing married in the 12% bracket. So sorry to hear about your loss, first of all. And you're in that situation where we've just been talking about the suddenly single, and now Roseanne's tax situation has changed dramatically. So the QCD wouldn't work, but what you're saying about a Roth conversion and amount equivalent to the standard deduction for a single, so your tax amount, let me think about this. Yeah, I think that would work if you don't have any other income to write off that's going to already eat up that standard deduction. That would be the only caveat. Do you agree with that, Dave?
Yeah. So one strategy she may want to think about is if she's got some money in a cash account or in a taxable bucket, maybe it's in some mutual funds, what have you. She could live off of those funds. It's not going to go into her tax cylinder and consume her standard deduction or fill up the 10 and 12% tax brackets, and then she could, she could utilize at that point the standard deduction to offset. This year it would be half of 27.7, which is whatever that number is, 13.6.
Yeah, I can pull it up, and then you get another 18.5. I think it is 18.50 for
right if you're over age 65. So, and then you know what? I wouldn't stop there. Because the 10 and 12% tax bracket, you're going to get hit 2030 and look back on the year 2023 and say 10 and 12%. That's a good deal of historic proportions. Why did I not convert to the top of the 10 and 12? So I would say not only utilize your standard deduction, but convert to the top of the 10 or the 12, 10 and the 12 as well. I think that's a tax sale of a lifetime that's hard to pass up.
Yeah. Yeah, and I so Roseanne, if you send me that email, I'm happy to schedule. I know we've talked before, but I'm happy to schedule some time for you. And now that your situation's changed, we can do another comparison and see what makes sense for you. So happy to do that. I think you're on every one of the webinars every week, and I appreciate that. And you always have good comments. Anthony and Denise write, hello. Are there any Roth conversion options, backdoor, et cetera, or the Roth itself subject to legislation change in the future? Great question. This always comes up. So Dave, do you want to take that?
Yeah, so there had been a lot of talk that the backdoor Roth conversion, which basically means if you make too much money and can't deduct your IRA contribution, you can use after-tax dollars. And then, you contribute it to the IRA with after-tax dollars, you sign a conversion form, and the net effect is that you contributed to a Roth IRA. It ends up in the same place. All you had to do is sign one additional piece of paper. There was some talk that was going away, but lo and behold, Secure Act 2.0 came out and they did not touch it. So it's still around, and it's still something that you can take advantage of. They didn't change any of the other rules. There had been some discussion over income limitations that if you, sorry, not income limitations, but balance limitation. If you had a balance, say, above $10 million, and this was inspired by Peter Thiel's $5 billion Roth IRA, so that if you had IRA balances above, say, $10 million, they would force you to convert a portion of that. None of that materialized in the Secure Act 2.0. So really nothing changed as far as Roth conversions go.
Yeah, and in fact, things got better, right? So with Secure 2.0, so Rothification is the trend coming out of Washington. So now we have the abilities for SEP IRAs to be Roth. That wasn't the case 6 weeks ago, right? Simple IRAs can now be Roth. That wasn't the case 6 or 8 weeks ago before it came out. Employer contributions can now go into the Roth option in the 401k. That was not the situation six or eight weeks ago. So it makes me feel very good about the future of Roth IRAs, because Washington doesn't think like we all do. Washington wants those tax dollars now. We're long-term planners. We understand that you've got to pay for things now and plan to pay for things later and put yourself in a better position. All they care about is their little tiny window of their election cycle of 2 or 6 years, right? So, really, really great question, Anthony. You got to be really careful about the backdoor Roth contributions, though, because if you have money in an IRA and I'm just going to give you an example, and you contribute $7,500 of a non-deductible contribution into your IRA, and then convert that over to the Roth, you're going to get stuck in what's called the pro rata rule, and only a small portion potentially of that conversion is going to be tax-free, and you're not going to like the outcome. And it's a nightmare to track. There are ways around it, and it's certainly a good technique to look at. And that is one time that you can put money back in your plan. You can, there's a lot of things do, but you got to be careful about that one. But really great question. Thank you. Andrew asked a great question again. So Andrew asked, can you talk more about how life insurance could be a vehicle to be used for retirement planning? Do you use taxable monies to buy the insurance? And what kind of insurance is recommended? Good question.
Yeah, so I got a whole chapter in my book, chapter 5 of The Power of Zeros, called the LIRP. Stands for Life Insurance Retirement Plan. I think that there's some things that the life insurance retirement plan gives you. Remember, we talked about how all of these 6 streams of tax-free income have unique qualities that the other ones don't. So I'm going to tick off some of the unique qualities that I think the LIRP has. I'm also going to preface by saying that a lot of people try to position these LIRPs as silver bullets or panaceas. They're not. They serve a very particular, specific purpose. And they need to be used in just the right way, but I'll talk about some of the unique attributes. You are using after-tax dollars. The type of LIRP I typically recommend, I wrote a book about why I like this particular one. It's called Look Before You LIRP. It's called Index Universal Life. Index Universal Life, you put your money in and the growth of your cash value is linked to the upward movement of a stock market index. Typically the S&P 500, whatever the S&P 500 does in a given year, you get to keep up to a cap, we'll call it 12%. And if the S&P 500 ever goes down in any given year, they simply credit you a 0. So you're always going to be making anywhere between 0 and 12%. Over the last 16 years or so that these types of programs have really been around in any really meaningful way. We're looking between 7 and 8% gross of fees. The cost of these programs over the life of the program is going to be at 1%. So if you got 7.5% growth, you're going to be netting about 6.5%, which is a safe and productive way to grow at least a portion of your money. And I often talk about, and Mark, you and I have talked about this before, how the LIRP can be a meaningful bond alternative. You reach into your portfolio, remove the bonds, replace it with an LIRP. You're going to increase your overall return. You're going to lower the risk, lower the standard deviation of your entire portfolio, and have a better outcome over time. So, but of course, the real crown jewel of the LIRP is that you get that death benefit. And should you end up needing long-term care sometime, you typically need it the 2 to 4 years before you die. If you should end up needing long-term care, they will give you the ability to receive your death benefit in advance of your death for the purpose of paying for long-term care. And like I said before, If you end up dying peaceful in your sleep, never having needed long-term care, then your kids or your grandkids get a death benefit. So it's not like you paid for something that you never used. And so, like I said, it's not a silver bullet. It should never be seen as a replacement for a Roth IRA or a Roth 401k or a Roth conversion or what have you. But it does play an interesting role in the balanced, comprehensive approach to tax-free retirement planning.
Yeah, great answer. And the thing that frustrates me about the using the LIRP, because there's such great tools and they can be so impactful, is that not everybody can do it. Right? That's the frustrating. Like anybody can do a Roth IRA who has a traditional IRA, but you have to go through that approval process. Now, if that's where kind of knowing the ropes and having the right people in place makes a big difference. And I often talk about your team, right? Having a qualified financial planner. I think that person should be a CFP, certified financial planner. I also think that person should be part of these specialized groups like Dave's, the Power Zero Elite group, and Ed's, Master Elite Advisor group. You want a good CPA in your group, and for all the reasons that I think you should have a CFP, I think it should also be a CPA and at least one attorney who's an estate attorney and probably an elder law attorney. Not that you may be elderly, but there might be somebody in your life who's elderly. So it's good to have all these people working for you, and you want specialists in those areas. And I say this because they can be powerful tools, but you got to know what to look for. Read Dave's book, Look Before You Learp, because I get questions about that when people come in. I love that when they say, okay, these 2 items, how does that, or 10 items, how does that cover that? I think it's 10, right? Dave, don't you have a list of like 10?
I think it's 8. And by the way, that's an abbreviated list. There's about 25 things your LIRP should have. I chose my 8 favorite for that book. They're about 25.
Sometimes it's just persistence. And I like to tell this story. We have clients who are they're retired now, insurance actuaries. So that this means that husband and wife actuary team, and they wrote these policies. They understand these intimately, honestly say much better than myself. Right. And they came to us and said, they attended a class and they said, we want one of these policies. Can you help us get it? And the wife got approved like that with 0 underwriting. And the husband was, he had crack open heart surgery maybe 5 years before that. And I'm thinking in the back of my mind, never going to happen. Well, we've got a great team who persistently just kept on it. And it took about, probably no exaggeration, 6 or 7 months, but we found a great answer for him. So it's about knowing what to look for, knowing how to handle things, and knowing, what companies to kind of zero in on that work right for you. Because, hey, Dave, your LIRP, cash value life insurance, IUL, is probably going to be different than this guy who had the crack open heart surgery for different reasons. But it's important. A great question, Andrew. Thank you, because that's such a powerful and important part of the plan. So, Dave, let me ask you this. You always end your presentation with, it's all good news, right? So what's the good news as we sit here March 1st, 2023?
Gosh, that's, we've talked about what I think is the good news, and then you've sort of flipped your paradigm since last year. I believe in my heart of hearts that that if you're in the current 24% tax bracket or lower, I think you can probably plan on that being extended another 8 years beyond the date where they implement that extension. So if they implement it this year, 2023, add another 8 years. If they implement it in 2024, add another 8 years. So there'll be a sunset on that. So I think that no matter how much money you have in your tax deferred bucket, if you have 8 or 9 years to be able to execute that shift, and remember what we're trying to do here is we want to shift the money to tax-free slowly enough that you don't rise into a tax bracket that gives you heartburn, but you want to do it quickly enough that you get all the heavy lifting done before tax rates go up for good. So, I think that's good news, that it's not necessarily going to be just a 3-year window. I think it could be an 8 or 9 year window. And like I said before, whatever happens in the future, life happens, anything could happen, but that's what my gut is telling me right now based on what I'm hearing through the grapevine. So that's about as good a piece of news that you can get in the face of what the Congressional Budget Office is telling us about what tax rates would have to do to keep our country solvent.
Yeah, and if I can add to that, if you don't mind, another couple pieces I think are, first of all, the good news is that you're paying attention now and you're listening. You're listening to, you're on this webinar. You're listening to the weekly webinars. You're following, you're going to follow Dave's podcast and his YouTube channel, and you're going to learn, and you're going to be, you're solidified hopefully in your decisions, and it is an ongoing thing, folks. It can't just like you can't put a financial plan on the shelf. You have to remember you're overcoming 40 plus years of conditioning about, what was told to be best, and we all know is wrong now. So when I talk about reviews with clients in our planning discussions, I often call them reviews and reminders, because we have to remind clients that this is why we're doing this. This is the math. This is because people come in and they have an excitement level. Well, I'm going to have $2 million more at age 85 that I can spend, pass on to the kids, anybody but the federal government, without increasing my risk, decreasing my income, any of that. And that's exciting. And they're excited about it. And then they talk to their brother, plumber, friend, or whomever, and they just forget. And so it's this review and remind. And so knowledge is important, and you're doing that. And we have these great tools for knowledge, but we also have other great tools. And we should thank Congress for the Roth conversion. What a gift that is, to be able to take something that we thought was going to pan out one way. Now we know it's going to pan out another, but we have the choice of what tax rate we can pay to fix the problem for us.
Yeah, let's not get too lovey-dovey about the government. we know that the government, Roth IRAs are the one thing that both the government and everyday Americans love. And it's one of the only things that we both love, because they get their revenue right now and they get to spend it on stuff that keeps them in office. We like Roth IRAs because we know tax rates are going to be higher down the road, and we get to protect our hard-earned retirement savings from the impact of higher taxes. I'm hard-pressed to think of anything else out there that where the government and everyday Americans love it, but that's one of those things.
That's why I call it a gift. We always talk about the I don't know tax rate, because if I can convert myself, clients at 22-24% instead of the, I don't know what it's going to be, but it's going to be higher than this, it's a gift. So that's all good news too. I appreciate that, Dave. I appreciate you hammering that home.
Okay, folks, that was the end of part 2 of my interview with Elite Power Zero advisor Mark Bialik. If you want to learn more about how to shield your retirement savings from dramatically higher taxes, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power of Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.